Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to when you want to learn how to take an apartment building and turn it into an amazing community. So I have here someone that has really a unique story. Her name is Carmen Dettloff, and she is an investor in different states, based out of Washington, but really kind of a unique and cool story because not only is she an investor, but she is a mathematician. Used to be a professor, now full-time investor. So I really, I know we're gonna have a great time. This is gonna be a very fun conversation, but one very insightful because we're speaking to someone who always looks at the numbers. So Carmen, welcome to the show.
Thank you so much for having me. Excited to be here.
Hey, you're very welcome. So I'm gonna invite our audience into this conversation by starting them off with your bio, okay? So Carmen is an experienced real estate investor, entrepreneur, and founder of Bigfoot Equity. Carmen started her real estate career over 15 years ago and has broad investment experience in flipping, renovating, and adding value to properties. So Carmen is currently invested in over 1,000 units, passively and actively. So hey, welcome to the show. Really excited to get into this conversation with you. I know you're based out of Bellevue, Washington. So tell us, Carmen, a little bit, how did you get into this business, right? You started off as a professor of mathematics. So the mathematics piece, I totally get. The professor piece, I'm very curious to learn more. So tell us your story.
So before I was a professor, I worked in industry. You know, I was a mathematician, and I had a coworker, and we were talking about retirement and real estate. And I was like, I really want to do this, but I don't know where to start. And it was like 2009-ish, and we'd kind of done some smaller things, but he kind of got us hooked up with the fix and hold, the burr method. And we started doing that more seriously. And then I was like, I love this so much. I want to do more. And I did a little wholesaling, and we tried our hand at flipping. And I mean, all of these things are really hard to maintain while you have a day job. They take a lot of time and effort. And, we always, read in the books like multifamily. Oh, it's like this amazing thing, like this thing you want to obtain, it's out there. And we were like, we do not have enough capital to do this. And, a couple of years ago, I learned about syndications. And that's when we started invested passively in syndications. And then I got even more interested, and I decided to pursue it full time. And I quit my job as a professor to pursue syndications. And in February, it closed on 152 units in Kansas City. And, just been going from there.
February, now that's February this year, right?
February this year. Before that, I had been, I JV'd on a few syndications as well, learned along the way. And this is my first one as the lead syndicator.
Okay, cool. So talk to us a little bit about that experience. So tell us the story of that deal, right? Just walk us through that acquisition, how you found it, how you bought it, how you capitalized it, all the good stuff, all the juicy stuff.
Sure. I first started, I looked in Phoenix first, and it was so expensive. I could not make the numbers work, and I'm a numbers person. So I was like, I got to start pursuing other cities. And I, already invested a lot passively in Memphis, and I wanted to look someplace else to diversify. And when I looked at the fundamentals of KC, I love the job diversity and low cost of living. So I was like, I'm going to start looking there. And I reached out to brokers, and somebody sent me this deal. I looked at it on like a Friday. I liked it, and I flew out on a Monday. And I took a look because offers were due really quick, and took a look, and we made an offer that week. And we didn't get it. Somebody else got it, and turned out they couldn't close, and we were in second position. So they called us back, and we, I was still really excited about it. And so we decided to pursue it.
So walk us through the metrics of that deal, right? In terms of, the financials, the metrics, walk us through the metrics. You being a math person, I know you're going to love this.
Okay, so the building was previously owned by a church, and they had not been running it as a business. They had been running it more as a nonprofit. They had not been pursuing upgrades or rent bumps. And so when we bought the property, our goal was to renovate it. Their occupancy was, in the high 80s, but not really where you want it to be.
Right.
And a lot of deferred, not necessarily maintenance, but deferred upgrades for sure. I mean, the interiors were nothing to be proud of. So we're working through renovating them and bumping up the rents. There's been people that have been living there for 40 years, people that are paying, $400, $450 for a 3-bedroom. And that's wildly under market for there.
Right.
So we, are just going through and trying to bring people up to market rent and not get them closer. Not everyone, if you're paying $450, you're not going to jump to $900 overnight.
Sure.
But get people up slowly, and then also renovate vacant units. And as we turn, we're improving the community overall and making some really nice improvements to the property that the tenants are really liking. Plus, we did another big thing that we did to help with the numbers is we did a water saving project where we replaced all the toilets, the water heads, in the sinks and the shower heads. And we're cutting, that project costs about $60,000, and it will pay for itself in 2 years. And then after that, all that water savings get passed back to the investors.
So are you, when you're implementing your water efficiency program, the water savings program, that $65,000, was that for all units or
that was
just
for all units? Yeah.
the vacant? That's actually pretty good.
Yeah, it's a really good cost. And we actually didn't include it in the pro forma for investors. So it's just a really fun surprise for them too, because we decided to do it last minute when we found out the cost and that it was, a good fit for the property.
Yeah. So talk to us a little bit about what was included in that package, right? So, I know you mentioned water heads, usually shower head. There's some things that you can do with the toilets, right? Putting just low flow toilets in, also making sure that the toilets don't leak.
Yeah,
and
all of the above. I mean, these had old toilets, right? This is, 70s, late 60s build.
Right.
So these are all 6-gallon, 5-gallon toilets. We replace them with the 1.6-gallon toilets, plus the low flow shower heads. I mean, the water savings is huge. I think, I can't even remember. It's like over 1 million gallons a year that we're saving. I can't remember. It's vast.
Right.
So it's
okay, cool. Now, is this in a primary market, secondary market, tertiary market? What kind of market is the asset?
I mean, Kansas City, I'd say, is a secondary market. It's in Leavenworth, which is, it's kind of a suburb outside of Kansas City. And I really like it because one, I mean, it's growing a little bit, not a ton, but, enough to be good. And then there's a really big prison there, and the prison's never going anywhere. I mean, realistically, I don't want to get into American society, prison, blah, 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 but it's not going anywhere. We're going to have the prison. And so it's a great source of jobs for the community. Okay.
So how many people, what's the size of the population there in Leavenworth?
Leavenworth, I think in Kansas City is like 2.1 million, and Leavenworth, the burb, is like about, I want to say 50,000.
50,000. Oh, wow. Yeah. It's a small, that's almost like a tertiary market. It's really small.
It's like a tertiary market, but it's only like 20 minutes from downtown KC. So, it's like a bedroom community.
Interesting. Okay. And so when you were evaluating your rent comps, what were you using, right? Because in different markets, they have, for example, you have CoStar, which you can access national data through CoStar, but oftentimes in non-disclosure states, CoStar is not very accurate. Now, is KC a disclosure state or a non-disclosure state?
I don't know. I verified the rents myself by, one, I looked them up and called and verified the numbers. And then I drove those properties to make sure that, it was fair comparison.
Now, did the broker give you those list of properties, or did you find that list yourself prior to flying out?
I looked at the CoStar report for the, kind of the comps, the big ones in the area. And then I called to verify the prices from there.
Meaning called the property manager to verify the prices.
Called the property manager to verify.
Okay, cool. All right, so let's kind of move through that, right? So let's talk a little bit now about financing. So talk to us about how you finance that property and, how you put together your capital structure.
Sure. It was at 88% occupancy when we purchased, so it didn't qualify for Freddie or Fannie. So we used a bridge product, and we are on a 3-year with 2-year add-ons if we need to. And we plan to refinance in year 2 or 3, depending on how things are going, to Freddie or Fannie, depending on how things go.
Sure. Yeah. And so what was the rate that you got on the bridge loan?
It was good because it was in February. I want to say was like low sixes or something like that. I'd have to double check.
How big was the loan, just to give some context around
Yeah. The loan itself is like 6.2, I think.
6.2 million?
Yeah.
So the purchase was maybe 8.5 million, somewhere in there?
No, the purchase was lower and we added on the renovation costs to the loan. So the purchase price was 5.7, and we have the renovation costs that we added on.
Oh, I see. So you actually financed
He financed the renovation costs.
the renovation cost. So let's see, 150. So you're paying like, you said 150 units, right?
152, yeah.
150 is like
40
a door.
Yeah. Mm-hmm.
Interesting. Awesome.
Yeah.
Okay. Now, so you came in with a loan. How much did you have to put down on the property for the purchase?
You mean earnest money or what part?
Did you finance 100% of the acquisition with a loan?
No, we had 80% loan to value.
80%. Okay. So you came in, the balance of that was equity. All right. So now you get to tell the amazing story of how you raised equity for your first acquisition.
Sure. I had some partners on that also helped me raise that, we're partners throughout the deal and are also helping as we continue to go on.
Right.
And we, put together a presentation, did a webinar, and, reached out to people that we thought might be interested. And we were funded in 7 days from making it live, or 7 to 10 days. I can't remember exactly.
Okay, cool. So 7 days to raise how much?
About $2 million.
About $2 million. All right.
Yeah.
And so, you meant, it sounds like there are 4 or 5 of you. So did that webinar go out to everyone's network of?
Yeah, going out to everyone's contact list, right?
Yeah. Okay. Gotcha. That's really smart. That's very, very smart. Okay. So what was your greatest lesson learned going through that experience with your first acquisition? I would say since we're in a couple months, one, having, a good property manager is most important, right? You got to trust that they're your boots on the ground, especially since like immediately after we closed into February, COVID happened and travel was, really difficult / concerned about it. And so knowing that I can trust the people that are there is critical to me feeling confident sleeping at night about it. Okay. So we talked about the acquisition. We talked a little bit about financing, the debt and equity side, and how you were able to finance it with equity, right? Where that equity came from and how you did that. And then the third component of that now is, let's talk about asset management, right? So I know that you closed on this in February. So you probably have some really good stories, or maybe not so good stories, about the property management side of the business. But talk to us a little bit about your greatest learning experiences to date managing that asset.
So I actually have a third-party asset manager that manages it for me. I'm a mathematician, and I don't like the communication on the details, the minutia. It just doesn't gel with my personality, and I knew that going to it in advance. So finding a asset manager that could manage this stuff daily, is so important. I still attend the calls weekly, and I still participate, but I just want someone else to handle it. So they do, and they do a great job, and it makes a big difference for me and my stress level.
Okay, so you have a property manager managing the property. Now, who on your team, though, interacts with a property manager?
Our asset manager usually takes care of it for me.
Okay, but they're a part of your team, correct?
They're not an employee.
Say that again, I'm sorry?
They're not an employee. They're a third-party person.
Meaning the property manager is a third-party person, or asset
both.
manager?
The asset manager is a third party.
Okay, so talk to us a little bit about that, right? Because you have an asset manager and a property manager, and they're both third parties. So talk to that a little bit.
So the property manager is there every day on site, and then asset manager manages them as far as, their cost, timing, occupancy, just following up on these types of things that managing the property manager. And I just didn't feel like it suited my forte and found somebody that could do it, that has a lot of experience. They had managed a great deal of my portfolio as a passive investor, and I've loved their results. And, I like their communication and the way they handle stuff. So that's what really drew me to them.
Interesting. I've never heard of anyone delegating out the asset management side of the business and the property management side of the business, right? But I'm really kind of fascinated that that's working for you. But it sounds like the person that's doing the asset management, are they vested in the deal? Do they have money in that deal?
They do not.
Interesting. Very, very interesting.
Yeah.
Well, yeah, that's a new one for me. So when you carve that out and you figure out how to make that work successfully and you have some proven results, we're going to talk again.
Yeah. Well, they manage all my other stuff. They manage, everything that I've invested in, pretty much everything I've invested in passively, they are the asset manager on.
Interesting.
And that's why I was like, I know that you could do a good job. And it's just not an area I felt confident about for myself.
Sure. Well, I think, a couple of takeaways here, right? It sounds like, you know yourself well enough to know what you want to spend time doing.
Yeah.
And what you don't want to spend time doing. I think some of the pitfalls, though, happen, in my experience, when you detach yourself so much from the execution of the plan that, you still have to be tied to the execution of that plan, right?
Oh,
so
absolutely.
how do you do that? How do you stay informed with execution to make sure that the business plan is still being executed on as you kind of move forward?
So we still have goals and milestones, right, that we're trying to achieve as far as renovations, occupancy, et cetera. And I attend the calls weekly that we have with the property manager and the asset manager, but I don't do the follow-up. I let them, we check in, but I should counting on them to follow up. But, obviously I can tell based on the calls if we're falling behind based on schedule, where we stood with last week. But I don't want to follow up on the minutia details and, call back. They do a great job of being like, 3 weeks ago we discussed X and we haven't pursued that, and they do a great job with that. And I'm still engaged. It's just, the minutia of it is not my forte, and they do such a good job with it.
But Carmen, math is minutia.
Math is minutia. Oh my gosh, that's numbers. This is words.
That's so funny. All right. So what's been like one big takeaway that you can share with our audience around the asset management side of the business that you feel, would be a great value add for our listeners?
I'd say for asset management, if it's not something you do well, have someone help you out with it. There's no shame in that by any means. If I didn't have this company, I would definitely have somebody else that I partnered with to help me with the asset management. That just is much more detail oriented with words.
Okay. And so 3 things that you could share with our audience. So if you were so for the next deal that you acquire, mm-hmm. right, and you outsource the asset management piece, what are 3 things that you would do to make sure that you get the same level of result, right, or you have a great experience on the asset management side, right? What would be 3 things you would share with our audience about that?
Mine, don't be afraid to be a pain in the ass. Okay. If you don't like something, you just keep pestering until it's fixed. That's me. I'll just never let it go until it's fixed.
Right.
And on the asset management side, if you are not seeing the results you want from your PM or from your asset manager, either way, execute on that quickly, and let them know that you're unsatisfied and you need things to change, because you don't want the direction of your property to be going the wrong way, and course correct quickly.
Right. Okay, good. I really appreciate that. Hey, well, this has kind of been a really cool conversation, right? Because for one, you started this quest, it sounds like maybe about 2 years ago, or a little bit more than that.
Yeah, a little bit more than 2 years ago, we sold our first single family and invested in some syndications. And that's when it kind of just began. Awesome.
And so what's the capital structure? What is it? A 80-20, right? 80 to...
For the syndication?
Yeah.
30-70.
A 30-70. Okay. And then talk a little bit about the structure and why that structure, and is there a preferred return hurdle in there?
There is a preferred return of 8%. Yeah.
Okay. Mm-hmm. Very nice. So talk a little bit about that. Why the structure, why the hurdle, what have you learned, in that process, and what are you going to do differently the next time is a really great question, right?
Okay. So for the capital structure, I think investors, I always look at it as, what do I want to see to put my money in a deal?
Sure.
And I want to see a pref of something, right? Pre-COVID, it was 8. Now, I think it might be shifting. I'm seeing stuff shifting down a little bit to maybe 7. But I do want to see something for a pref as a passive investor. So I know my investors will also want to see that. And then the 30-70 split, I mean, we put a lot of work and time into it. And I don't think that for any investor, I haven't talked to anyone that's been like, oh gosh, why do you get, the split? Because there is so much effort and time to find a deal, maintain.
Right.
And then once you get past that 8% hurdle, they're already, investors are happy because they've already hit, their target, and hitting 8% in the market right now is a great return. I mean, obviously we're aiming for higher than that.
Sure. And does that preferred return, does that accrue, or does that come out of cash flow?
It comes out of cash flow, but it does accrue if for some reason we can't pay.
Got it. Okay. And then in terms of the project, what were the project level returns that you were projecting, and how is that performing to date?
We are projecting 10% cash on cash return, and double the money IRR of I think 19% over 5 years. And our first distribution is scheduled for October after 6 months of holding. And right now we're still on schedule for that.
Okay, cool. So if I understood you correctly, the project level returns in terms of yield, right? Return on cash, 10%. And then on the internal rate of return metric or side of the business, I think you said, was it 17 or 19%?
I think it's 19. I have to go back.
And so how did that, how did the, now you in your projections, you weren't scheduled to make a payout for, was it 6 months, 12 months?
6 months, yeah.
Interesting. Okay.
And the first one's for October, and we're still on schedule for that.
Very cool. Very cool. Yeah. So what was the biggest takeaway from that whole experience?
I would say if you're starting out and you're looking, it's hard, right? You got to work hard, pound that pavement, get with those brokers, run those numbers. And if you're a lady, I'm going to say it's twice as hard, right? Because it's hard to get people to take you seriously, right? So I say for me, when I first looked in Phoenix, I kind of got my jitters out. I said my idiot things, the things when I was unsophisticated and didn't know what to say. And then when I rolled up to Kansas City, I was like, okay, these numbers look better. But also I felt like I sounded better because I was more confident, and I already, said the most idiotic things to people. And I already done that part.
Hey man, so I really like that. So let me kind of recap that, right? For our listeners, the folks that are looking to get into this business, especially, I really like that. So start off learning in a market that you're not going to spend all of your time and energy in, right?
Yes. Start someplace practice.
That's so smart. I love that. That. Let me go make mistakes in Arizona.
Yes.
So that I can then actually invest my money in Kansas City.
Exactly. And it worked out great.
Oh, that's good, Carmen. That's good. Hey, and it worked, right? It worked. So you found your first deal. So where do you go from here?
I'm continuing to look in Kansas City, and I'm starting to look at a couple other markets as well. And I'm, looking for the next deal that's going to bring good returns for my investors.
Very, very nice. Hey, well, you've been a great guest. This has been a really cool, I really like this conversation, right? Because someone that started 2 years ago really had an interest in getting into this business, took the action forward. You even liquidated an asset to have the cash to make the investment into this business. So you put your money where your mouth was, right? Because now you actually own 150 units. And of course, I know you're going to scale beyond that. And, you're still pursuing opportunity forward. So where do you see the opportunity now that the market has shifted with COVID-19?
I think that who knows exactly what's going to happen. Right now, I think demand is so crazy because people are looking for a safe haven for capital, and they're viewing apartments as a safe haven. So I can't say for sure, but I think demand is going to continue to go up because I don't think that people are going back to the office anytime soon, and people aren't signing new leases on offices. So that automatically, has a segment of investors that invest in real estate that are looking for a different place to place their capital.
Sure. Very interesting and very nice. Carmen, you've been a great guest. Thanks so much for being on, the show. I think, it was really nice to be able to walk our audience through a cycle of a multifamily investment, right? You started with the acquisition side of the business. Then we went through capitalizing the asset with debt and equity. In this case, you used the bridge loan. You also were able to roll your improvements into the loan. Now, did they do a holdback for that money, or did they actually advance that money up front?
They did a holdback.
Okay, cool. I've done it both ways for folks that have worked with me for a while, right, where they'll advance the money, but typically I understand lenders want to do that holdback. Did you use fund control, or was the lender the control?
The lender's the control.
The lender was the control. That's even better, because typically they're going to be a little bit more flexible because they're direct to the deal, right? You don't have that additional layer there,
yeah,
which is really, really great. And so for this asset, we also capped it off with management. And, you shared with us the strategy on outsourcing not only your asset manager, but your property manager. And so I find that unique. And guess what? I'm sure you're going to find a way to dial that in over the next couple of months, because the more you work inside a structure, the smarter you get at it. But what an amazing business, right? Because there's no one way to do this business.
I love real estate because there's 1,000 ways to do it, and anyone can get started at any level. It's great.
Yeah, no, and I really appreciate you sharing that. You've been a tremendous guest. What is the one question that you have for me, Carmen, that you feel can add some value to our audience? And then we're going to, ask you to share how people can get in touch with you.
For you, I'd ask, what advice do you give people who, just want to get started, but they don't have a lot of capital, and maybe they don't want to do a syndication?
They just want to get started. They don't have a lot of capital, and maybe they want to do a syndication.
They don't want to do a syndication. Maybe, they have a moderate amount of capital, but they, want to get started for themselves.
Okay, when you say they want to get started, let me qualify that a little bit. When you say they want to get started investing?
Get started investing. They want to get invested in multifamily.
Okay, actively or passively?
Either way. What would you recommend?
Okay. Let's see. When I look back on my path, and this is only my experiences, I think one of the biggest takeaways from my own experiences is the first thing is you have to make a decision, right? It's like you have to make a decision. Either you're all in or you're not. Because being midway is not going to create any value to you or any benefit. In fact, all it's going to do is slow you down and get really, really expensive, because you're likely going to end up one of those folks who chase 30 different training programs, spend a bunch of money on training, and then ultimately do nothing, right? And then you get pissed off at all the trainers, but ultimately you didn't take the action. You consumed all this content, but you did nothing with it. So I think the first thing is you just really have to make a decision. And whatever that decision is, it's okay, right? Whether you're going to be all in as the pursuit as an operator, right? An owner operator. Okay. Or you are going to be passive, or you just decide that, hey, look, this is not for me. But I think a lot of that is going to come down to you knowing yourself, like what you described on this call a lot. Some people want to be actively engaged in the investment business because they find it fun. And that's what you described, right? I mean, your personality is such that you love solving problems, right? Your math background, okay, you're really good at problem solving, and so you like injecting yourself in problems. Some people don't want to do that. My very first partner in this business was my CPA, literally one of my very first partners. Okay, and he had a really big practice. He was great at what he did. He did not want to be an operator, but he understood, he understood the value of making an investment in something that he could actually see, touch, feel, right? And he understood real estate because one, he does accounting for a lot of it in many different partnerships. So he understood it. So for me, it was a great fit, right? It's like, hey, John, I know who you are. I've worked with you in banking for many years. I'm willing to put my money behind you. You're going to be my racehorse, but I still love being, a partner in a practice. So that would be my first level of advice. Know who you are, make decisions accordingly. If you're someone that doesn't want to be active in a project, then make a decision to be passive, but make a decision. And then the next step is, if you're going to be, an active operator, in this market, I think my advice would be different versus us not being in this market. Okay, so let me just talk about where we are today. Where we are today, I would align yourself with somebody that is going to put you in positions where you're going to be uncomfortable daily. Okay? Not just like a partner or a mentor or someone that you go and get coaching from, but someone who's really, really active at doing this, where they're doing this every day. This is their full-time position, and align yourself with them and literally have them put you in positions where you're really, really uncomfortable, right? And normally that's going to start with underwriting, and it's going to start with being able to communicate and source opportunities. The other side of that too, though, is I know some people that start off as property managers because they just love that side of the business. They're operators by nature, right? They're like really big time process people. And so I have friends who have created a career, very successful careers at building out property management companies, or starting as a property manager and working themselves up through that channel. And then once they understand the operational side of the business, then they start acquiring or aligning themselves with other large acquisition companies. So those would be my two recommendations. Nothing is perfect in this space, but there's no like right answer, right? The only answer that I know is right, that I can stand behind, is if you don't take action, okay, nothing's going to happen.
That is so true.
I can say that with 100% certainty. So whether you choose to go down the path of an operator, right, a passive investor, or a property manager, ultimately it's going to come down to action. And then lastly is you have to have resolve, right? I mean, and you spoke to this, I think people don't talk about this enough. Any business where you can generate and create a massive amount of wealth is just not going to be easy. And when people tell you that it is,
they're lying.
Just not true.
Yeah,
it's just not true. But because there are barriers to entry, you should actually be really excited, because that means not everybody can do this, right? Not everybody can do this business, but you have to have resolve. You have to have, fortitude, and then just a willingness to work through challenge. And of course, you do that consistently over time, you'll create success.
Absolutely. I love that.
Okay, awesome. Well, hey, thank you for the question. Very good question. I really appreciate you. Carmen, how do people get in touch with you if they want to learn more about who you are, what you do, and how you're changing the world? What would be the next step?
You can check me out at bigfootequity.com.
Awesome. Hey, well, I wish you continued success. Congratulations on your acquisition. And I look forward to our next conversation when you're at 500 units.
Awesome. I can't wait to talk to you then.
Awesome. Thank you.
Bye.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.